Hello, everyone, and welcome to the market opening bell on Tuesday, May 27th. Last Friday, US President Donald Trump threatened to impose a 50% tariff on all EU goods starting in June, but later agreed to delay the tariff until July 9th. Despite this, Hong Kong stocks fell on Monday. The Hang Seng Index opened 95 points lower, briefly narrowed its losses to 30 points, reaching a high of 23,571, but the decline widened to 366 points in the afternoon, hitting a low of 23,234. It closed down 318 points or 1.4% at 23,282. The Hang Seng China Enterprises Index dropped 146 points or 1.7% to 8,437, while the Hang Seng Tech Index fell 89 points or 1.7% to 5,157. The total market turnover was 223.5 billion Hong Kong dollars. Southbound funds recorded a net outflow of 1.507 billion Hong Kong dollars from Hong Kong stocks, with net buys in Meituan, China 2.082 billion Hong Kong dollars, China Mobile 842 million, Horizon Robotics 730 million, and China Construction Bank 564 million. Net sales in Tencent Holdings 2.092 billion Hong Kong dollars, Alibaba 1.732 billion, Tracker Fund 1.466 billion, BYD 1.05 billion, Xiaomi Group 695 million, Geely Automobile 286 million, Giant Biogene 278 million, SMIC 197 million, and Trees Bio 105 million. According to statistics, southbound funds have net sold Tencent for 15 consecutive days, totaling $19.756 billion. Xiaomi for 7 consecutive days, totaling $3.189 billion. Alibaba for 5 consecutive days, totaling $3.598 billion, while net buying China Construction Bank for 10 consecutive days, totaling $7.625 billion. Meituan for 7 consecutive days, totaling $5.948 billion. Technical analysis: as expected, the Hang Seng Index broke below its 10-day moving average at 23,480. If the 10-day moving average is confirmed lost, the next levels to test could be the 20-day moving average at 23,000 and the 50-day moving average around 22,780. Mainland Chinese markets adjusted in the afternoon, with the Shanghai Composite Index closing at 3,346, down 2 points, and the Shenzhen Component Index at 10,091, down 41 points or 0.4%. The combined turnover of Shanghai and Shenzhen markets was 1,009.9 billion yuan, down 145.6 billion yuan from the previous day. The renminbi central parity rate was set at 7.1833 against the US dollar, the highest in over 1.5 months, up 86 pips from last Friday, marking the largest adjustment since January 21st. The recent strength in the renminbi exchange rate is driven by two main factors. First, market concerns over the US government's fiscal deficit and rising debt have weakened the US dollar, boosting non-US dollar currencies, including the renminbi. Second, China's recent implementation of more proactive macroeconomic policies has enhanced the resilience of its economy against external volatility, providing internal support for the renminbi exchange rate. In the Hong Kong market, BYD recently intensified its promotion of 618 sales, launching limited time fixed price or subsidy offers covering 22 smart driving models under its Dynasty and Ocean brands, with subsidies up to 53,000 yuan Since late March, BYD has conducted these promotions for 3 consecutive months, effectively reducing prices through manufacturer and cash subsidies, expanding from 10 non-smart driving models to 22 smart driving models to boost sales. Meanwhile, Great Wall Motor chairman Wei Jianjun, in an interview with mainland media, stated that the auto industry has already seen an Evergrande-like situation that's yet to implode. His remarks dragged down auto stocks across the board. When China plans to regulate commission and service fees charged by online trading platforms to operators. Additionally, a People's Daily commentary on Monday pointed out that industries like China's food delivery platforms are experiencing low-level involution competition, which wastes social resources and could lead to a lose-lose outcome, urging authorities to intervene when necessary. Meituan fell 5.5% to 129.4 Hong Kong dollars, while JD and Alibaba dropped 1.7% and 1.6% respectively. After the market closed, Meituan announced its results, reporting first quarter revenue of 86.557 billion yuan, up 18.1% year-on-year, surpassing expectations of 85.253 billion yuan to 85.727 billion yuan. Net profit was 10.057 billion yuan, up 87.3% year-on-year, far exceeding expectations of 7.217 billion yuan to 8.462 billion yuan. Adjusted net profit under non-IFRS was 10.949 billion yuan, up 46.2% year-on-year, also beating expectations of 9.04 billion yuan to 10.128 billion yuan. Meituan stock fell before the results with its 10-day and 20-day moving averages, previously support levels, turning into resistance. These moving averages are currently around 134.5 Hong Kong dollars. Companies announcing results today include Xiaomi, Kuaishou, and Link-REIT. In the US, Pinduoduo will report. Xiaomi's first quarter revenue is forecast at 108.97 billion yuan, up 44.3% year-on-year, with its automotive business expected to contribute 18.44 billion yuan. As there was no automotive revenue in the same period last year, the auto business will account for 55% of the group's 33.47 billion yuan revenue growth in the first quarter, highlighting the importance of this new segment. Net profit is projected at 7.87 billion yuan, up 88.2%. Market focus includes its automotive business, investigations into auto accidents, and the financial impact of increased investments. At a recent conference, Xiaomi CEO Lei Jun announced plans to increase investments to 200 billion yuan over the next 5 years. Two new stocks were listed today: Jihong Shares, stock code 2603, and PacBio, stock code 2565. Jihong Shares closed at 9.6. Two new stocks were listed today: Jihong Shares, stock code 2603, and PacBio, stock code 2565. Jihong Shares closed at 9.61 Hong Kong dollars in Philip Mart's grey market, up 25.1% or $1.93 from its IPO price. Excluding fees, a 500 share lot would yield a paper profit of 965 Hong Kong dollars. PetBio closed at 15.02 Hong Kong dollars in Philip Mart's grey market, down 3.7% or 0.58 dollars from its IPO price. Excluding fees, a 500 share lot would result in a paper loss of 290 Hong Kong dollars. US stock markets were closed on Monday for Memorial Day. The deadline for Trump's proposed 50% tariff on EU goods has been extended to July 9th, and the EU has agreed to accelerate negotiations with the US. US stock futures closed higher, with Dow futures rising 457 points to 42,131. The S&P futures up 1.3% to 5,891, and Nasdaq 100 futures up 1.5% to 21,283. Our stock pick today is Lifetech Scientific, stock code 1302, a company focused on developing, manufacturing, and selling advanced, minimally invasive interventional medical devices for cardiovascular and peripheral vascular diseases and disorders. Lifetech operates three primary product lines: structural heart disease, peripheral vascular disease, and pacing and electrophysiology. Its structural heart disease business includes congenital heart defect occluders and left atrial appendage occluders. With four generations of congenital heart defect occluders designed to meet diverse patient needs through differentiated marketing strategies. The company also continues to enhance LAA occluders with innovative technologies, and given the large global population of atrial fibrillation patients, the market for LAA occluders is expected to grow significantly. The peripheral vascular disease business provides systemic interventional medical device solutions with products like vena cava filters and covered stents holding leading market shares in China. An aging population, rising disease detection rates, and expanding product applications are expected to drive steady demand for these products. In the pacing and electrophysiology business, Lifetech is China's first domestic manufacturer to offer a complete portfolio of implantable cardiac pacemakers meeting international technical and functional standards. With significant unmet demand for pacemaker implantation in China, domestically produced pacemakers have substantial potential to replace imported ones. Lifetech's distributors operate across Asia, Europe, North America, and Africa, with mainland China being its largest market, contributing over 70% of total revenue. Asia, excluding mainland China, and Europe are the two largest overseas markets, each accounting for about 10% of revenue. For the year ended December 31st, 2024, overseas sales increased by approximately 26% compared to 2023, driven by proactive expansion and effective marketing strategies. Recently, Lifetech announced that its aortic arch stent system, co-developed with Professor Shu Chang from Fuwai Hospital, Chinese Academy of Medical Sciences, received official registration approval from China's National Medical Products Administration, NMPA. This product, the first NMPA-approved covered stent system designed for aortic arch branch reconstruction using fenestration technology, is suitable for endovascular repair in patients with Stanford type B aortic dissection. It enables precise maintenance of blood flow to the left subclavian artery while repairing aortic lesions, offering an off-the-shelf solution for patients with insufficient landing zones or left subclavian artery involvement. The approval of this product enriches Lifetech's peripheral vascular intervention portfolio and expected to provide a complete, safe, and effective endovascular treatment solution for aortic dissection involving the aortic arch, with advantages such as reduced trauma, simpler operation, and better adaptability due to its fully interventional approach. The recommended buy price for Lifetech Scientific is 1.62 Hong Kong dollars, with a target price of $1.8 and a stop loss at $1.54. I do not hold this stock.